Greetings. This is market wisdom for traders, delivered by Twigbe Ehizoki. For forests, stocks, bonds, options, and all chart-related trading. Advice to subscribe, share with other groups, and make comments and ask questions. By the time a company's performance is so obvious that almost all institutions own a stock, it is probably too late to buy. 3 out of 4 stocks will go in the same direction as a significant move in the market averages. Top formation in the market averages occur in only one of 2 ways. First, the average moves up to a new high, but does so on low volume. This tells you that the demand for stock is poor at that point, and that the rally is vulnerable. Second, volume surges for several days, but there is very little, if any, upside price progress as measured by market closes. Another way to determine the direction of the market is to focus on how the leading stocks are performing. If the stocks that have been leading the bull market start breaking down, that is a major sign the market has stopped. Usually, after the Fed raises interest rates 2 or 3 times, the market runs into trouble, a sign that the market has stopped. A stock should never be sold short because its price looks too high. The idea is not to sell short at the top, but at the right time. Short selling of individual stocks should only be considered after the general market shows signs of a top. The best chart patterns to short is one in which a stock breaks out on the upside of its third or fourth base and then fails. There are no good stocks unless they go up in price. Remember, this is market wisdom for traders, and we are in episode 12. Remember to subscribe, share, and ask questions. The secret for winning in the stock market does not include being right at the right time. In fact, you should be able to win even if you are right only half the time. The key is to lose the least amount of money possible when you are wrong. Letting losses run is the most serious mistake made by most investors. Would you drive a car without brakes? You should hold the stock as long as it is performing properly. It is never your thinking that makes the big money. It is the setting. Realize that you never sell the exact top. Therefore, it is ridiculous to kick yourself when the stock goes higher after you sell. The goal is to make substantial profit on your stocks and not be upset if the price continues to advance after you get out. To say that a stock is undervalued because it is selling at a low PE ratio is nonsense. A common mistake a lot of investors make is to buy a stock solely because the P ratio looks cheap. Another common mistake is selling stock with high P ratios. There is no correlation between dividends and the stock performance. In fact, the more a company pays in dividends, the weaker their posture because they may have to pay high interest rates to replace funds paid out in dividends. It is naive to hold stock that are going down because they pay dividends. Diversification is a hedge for ignorance. By being very selective, you increase your chances of picking superior performers. You can also watch those stocks much more carefully, which is important in controlling risks. Remember to contact us for account management training. You can contact us on +234 80375 97085. This series is a compilation of the wisdom of some of the best traders in the world, like Warren Buffett, Paul Tudor Jones, Mark Douglas, and so many others. Advise to subscribe, share, like, and make your comments. Thank you.